Hello everyone, today we will discuss credit creation by commercial banks. Money supply in the economy consists of currency and deposits. Commercial banks are capable of creating credit more than the deposit which they receive from their customers. And creation of credit is an important function of commercial banks. This credit creation function of commercial banks multiply the money in the circulation in the form of bank deposit. That means credit creation refers to the capacity of a bank to create derivative deposits out of primary deposit. Now we can see what is primary deposit and derivative deposit. Primary deposit means a deposit arising from the entrustment of currency to the bank by a depositor. The primary deposit enables the banker to create additional deposit which can be called as derivative deposit. They are called derivative deposit because they are derived from the lending of the primary deposit. For example, if a bank receives a deposit of 10,000 rupees, it will increase the money supply to 50,000 rupees. How? Bank managed to lend more than 10,000 rupees. Whenever a bank lends, it creates a new deposit. For example, the process of credit creation by commercial banks can be better explained with the help of a simple model. To understand the concept of credit creation, let us make following assumptions. The first assumption is the public are highly banking minded, setting all transactions through checks. The second one is there is only one bank in existence. The third one is the total legal tender of money in circulation is 10,000 rupees. And the last assumption is banks keeps a cash reserve of 20% to meet the requirement of depositors. Under the above assumption, balance sheet of a bank will be as follows. For the sake of simplicity, only a relevant part of balance sheet of the bank is shown in our discussion. Customer deposit 10,000 rupees with the bank. It is called primary deposit. After this, the relevant transaction balance sheet of the bank look like this. The balance sheet consists of two sides, liability and asset. Deposit of 10,000 is entered on the liability side because bank has to repay it on the customer, and it is shown as cash on the asset side because bank is going to earn interest income by lending the money. Let us concentrate only on money supply. Money in circulation is 10,000 rupees. The bank keeps a cash reserve of 20% of total deposit. That is 2,000, and it advances rupees 8,000 to the borrowers. While granting a loan, bank does not give cash to the borrowers but simply credits the customer account with the amount of the loan and authorizes the borrower to withdraw money from his account to the extent of the loan given. The borrower may issue check in favor of his creditors for payment, in which in turn are deposited by such creditors in the same bank, since there is only one bank. In this process, transaction between borrower and the creditors are settled without affecting the cash balance of the bank. Now the balance sheet of the bank appears as follows. Now the total deposit with the bank are 18,000 rupees. It needs to keep a cash reserve of 20% on 18,000 rupees. That is 3,600 rupees. But the bank has 10,000 rupees as cash in hand. It can further lend 6,400 rupees. That means 10,000 minus 3,600. Now balance sheet of the bank will be as follows. In this manner, a bank can go on lending till 10,000 rupees become 20% of the total deposit. Therefore, the bank can have a total deposit of 15,000 rupees. That is 10,000 into 100 divided by 20. If it has a primary deposit of 10,000 rupees, the additional deposit of 40,000 rupees credited by the bank is known as a derivative deposit. From the above discussion, it is clear that whenever a loan is granted to a customer, new deposit arises. So it said that every loan creates a deposit and every deposit creates a loan. Next, we will discuss credit creation when there is more than one bank. So far, our discussion was based on an assumption that there is only one bank. But in actual practice, there are many banks. In such cases, also the total credit creation, that means advancing of money and generation of derivative deposit of the entire banking system will be remain unaffected. There may be a simple transfer of deposit from one bank to another. For example, there are two banks, SBI and Canara Bank. Mr. Thomas is a customer of SBI and Mr. Jacob is the customer of Canara Bank. Mr. Thomas draws a check in favor of Mr. Jacob, which Jacob deposits with Canara Bank. In such a case, there will be a transfer of fund from SBI to Canara Bank without in any affecting the total deposit of the banking system. I hope you get an outline about credit creation in commercial bank. Thank you for watching. Keep learning.